3Q17 Oil and Gas Market Update by Randall Kenworthy. Summary: Crude oil moves up while natural gas prices trend modestly lower in the third quarter. Global crude production remains stubbornly high from growing volumes in the U.S. as well as those exempt from the OPEC production cut agreement. Demand growth picks back up and is forecast to accelerate into year-end. Inventories across the globe have begun to inch down, but inventories in the U.S. remain stubbornly elevated. Crude oil moves up while natural gas prices trend modestly lower. The crude oil and natural gas markets diverged somewhat during the third quarter. Crude markets firmed up as global data became increasingly supportive of declining global inventories. However, continued resiliency in U.S. production and those exempt from the OPEC agreement remain a near-term challenge in fully balancing supply and demand. Meanwhile, natural gas was little changed during the quarter as ample supply and tempered demand from mild weather kept prices in check. The third quarter can be characterized as one with improving supply-demand fundamentals for crude. This contributed to a better near-term outlook and higher crude price during the period. West Texas Intermediate spot gained 12.3% during Q317 to end the quarter at $51.67. Global crude production remains stubbornly high. Despite efforts by OPEC to limit production growth, global crude production moved up during the quarter. Domestic production is on the rise. The U.S. Energy Information Administration, EIA, estimates that September production in the U.S. hit 9.34 million barrels of oil per day, up 570,000 barrels of oil per day from year-end 2016 levels, and is forecast to surpass 10 million barrels of oil per day by late 2018. Driving these U.S. production growth forecasts are gains primarily out of the Gulf of Mexico and the Permian Basin in West Texas. The EIA forecasts that production in the 7 major U.S. shale basins, Anadarko, Appalachia, Bakken, Eagle Ford, Haynesville, Niobrara, and Permian, will rise by a combined 81,000 barrels of oil per day from October to November, with over 60% of the growth coming from the Permian alone. Despite historically high compliance with the OPEC-non-OPEC production cut agreement, exempt members are more than offsetting attempts to curtail global production. Sequential quarterly production Q3 versus Q2 in Libya rose by 31.5% to 932,000 barrels of oil per day, while Nigeria saw production grow 11.4% to 1.79 million barrels of oil per day. This has contributed to total OPEC production growing by 453,000 barrels of oil per day during the third quarter. Crude supply remains above demand needs, but is narrowing as supplies are restrained and demand growth picks up. In fact, the International Energy Administration, IEA, forecasts the 2018 markets look broadly balanced, assuming OPEC holds output steady at around current levels. Demand growth picks back up. Demand growth continues to pick up and remains a bright spot in the improving outlook for supply and demand balancing. The average of the forecasts from EIA, OPEC, and IEA call for a 2017 demand increase of 1.47 million barrels of oil per day, up 110,000 barrels of oil per day from June averages, with total demand of 97.6 million barrels of oil per day. Improved demand growth and the potential for prolonged restraint in near-term production could maintain relative stabilization in commodity prices and a modest reduction in global inventories as we move through the last quarter of the year and into 2018. Meanwhile, domestic natural gas markets were little changed during the third quarter as mild weather, ample storage, and renewed growth in supply countered solid demand and prevented a possible rally. Henry Hub natural gas spot declined by 1.3% during Q317 to close out the quarter at $2.94 per million British thermal units. The natural gas injection season, typically April 1st through October 31st, is nearly complete. Inventories at the end of the 2016-17 winter season stood at 2.051 trillion cubic feet, effectively 427 billion cubic feet below last year's storage levels and 265 billion cubic feet above the 5-year average. Storage levels have normalized and at the end of September stood at 3.508 trillion cubic feet, 161 billion cubic feet below last year's storage levels, but importantly, also 8 billion cubic feet below the 5-year average. Natural gas supply is picking back up, in no small part from associated gas produced from oil wells, as well as a resurgence of the Haynesville in East Texas and northern Louisiana. On the demand side of the equation, the market continues to see a strong pull from exports to Mexico, as well as liquefied natural gas, LNG exports. It appears that future demand could push higher still with a new wave of industrial demand in its infancy, as well as new LNG facilities. On the industrial demand side, ExxonMobil recently announced that it had commenced production on the first 2 new lines at its plastics plant in Mont Belvieu, Texas. On the LNG front, the first of these new projects, Cove Point on the Chesapeake Bay in Lusby, Maryland, is expected to be in service before the end of the year. It would join Sabine Pass as the second large-scale liquefaction export facility to begin operations in the lower 48 states and the first on the East Coast. Coachman Energy Operating Company believes crude pricing may remain around current levels over the near term, given rising demand and muted production growth. We continue to maintain our position that it will take more time for the current inventory oversupply to fully balance and normalize. As always, wildcards remain, and some bear repeating. Will geopolitical risks in Iran, Iraq, or Venezuela, among others, boil over and impact global supplies? What will OPEC do with exempt members Libya and Nigeria? Will OPEC extend their agreement for a second time when they meet in late November? Will U.S. shale continue to rebound, or will it plateau? Answers to these questions, among others, will likely hold the key to how the oil and natural gas markets continue to unfold over the final months of 2017 and as we move into 2018.